Quick note, this video is sponsored by Webull. Deposit $100 with Webull and get up to $1,850 for free when you deposit $100. Now let's talk about Robinhood. Hey everyone, Meet Kevin here. In this video, we're going to talk about whether or not Robinhood is going to get banned. We're going to talk about the big old ban attempts going on with Massachusetts. We're going to talk about the attempts by the SEC. We're going to talk about fines and lawsuits. Let's go through all of this and try to figure out what the HE double hockey sticks is going on. And we got to talk about what happened with Doge and Robinhood this weekend as well, because let's just say I was trying to sell some Doge and it was a little bit of a disaster. And by a little bit a disaster, I mean a whole lot of this right here. Yeah, that's not good. Something went wrong. Please try again. I don't want to see that. And Robinhood probably didn't want to see that either in December of 2020 when the SEC charged them and fined them $65 million for deceiving users on how Robinhood makes money, which now we know has a lot to do with payment for order flow, which is probably their biggest source of revenue, which basically means that other companies pay to potentially process payments faster for Robinhood or transactions for Robinhood faster. But in the meantime, they get the opportunity to maybe make a little bit of spread and front run some of your orders when you place a buy or sell order, which means you might be getting the best pricing, but that might not be the best pricing. Yeah, if you're confused on that one, don't worry. I'm going to break down a loophole that we got to look at in just a moment. But stay tuned because, folks, this includes the fact that the SEC also charged Robinhood, not just for deceiving customers on how Robinhood makes money, but also for arguing that Robinhood gives their customers far inferior pricing than the competitors. And far inferior pricing is not any user of Robinhood wants to hear. Now remember, payment for order flow is not uncommon, but payment for order flow really blew up during the Robinhood and Gamestop debacle. Quick refresher, GameStop shares started skyrocketing as users on Wall Street Bets, which is a subsection of Reddit, were convinced that GameStop would suffer a short squeeze when they discovered that GameStop was over 137% short, which means there were more shorts outstanding than there were actual shares. As users flooded in, the price of GameStop shares rose, and on the losing end of that trade was a company called Melvin Capital, along with others of course, but Melvin Capital being one of the largest to have lost hundreds of millions of dollars to over $1 billion to $2 billion because they were shorting GameStop, and they were the unlucky short holding individuals or company when this big ol' short squeeze at GameStop happened. Citadel Securities is a company that ended up coming in to bail out Melvin Capital. But Citadel Securities also handles payment for order flow at Robinhood. And it's not only somebody who handles payment for order flow at Robinhood, it's potentially the biggest or maybe even the only company to handle payment for order flow at Robinhood. And so this naturally led to a lot of red flags that, wait a minute, if Citadel is bailing out Melvin Capital, that means Citadel is investing in Melvin Capital, and the more people buy GameStop, the more Citadel's bailout becomes worthless, and Citadel's a big partner with Robinhood, and Robinhood disables the buy button to prevent people from continuing to buy GameStop shares, leading to GameStop shares to plummet. You kind of start wondering, we got some potential shade here, whether or not that's actually what happened. Now, it all seems very fishy. Obviously, we talked to Vlad on this channel. You can see those interviews. Type in Meet Kevin Vlad from Robinhood into YouTube, and you'll see my interview with Vlad. And we see that Vlad says, look, Robinhood just couldn't handle the amount of reserve requirements that we needed. And that's because their argument was that the DTCC increased reserve requirements, and basically they woke up one morning and got a fax printout and went, oh my gosh, you want us to have that much money on reserve for us to be able to continue supporting GameStop stock? Sounds like we're not going to be able to support GameStop stock. That's their argument. They call it a 5 to 10 sigma event. We'll see. It's all very, very fishy. But relitigating what happened in the past isn't what's most interesting here. Instead, what's most interesting here, in my opinion, is talking about the whole world of best execution when it comes to order execution. So here's the thing. When you place a stock order at, let's say, $10 per share, usually there's a bid and an ask price. It's a range. So generally, your order will go through within a penny to 2 pennies of this range. Well, you'll put your order in at that range, and if it's a limit order, it'll go through at that range or it won't. And if it's a market order, it'll go through within a range. This range gives folks the ability, like high-speed traders, the ability to front-load your trades or potentially try to save you a little bit money by maybe ordering things in a certain way and batching things in a certain way, maybe doing some pairing before they go to the exchanges. Who knows exactly what it is they do? It's all very, very arcane. But the point is, the argument of these market makers like Citadel Securities, hey, well, we're going to do whatever we can to get you the best pricing on your orders. And for most people, if you put in a $1,000 trade, we're talking about a few pennies usually of a difference here. But over billions of dollars worth of trades in a year, we're talking millions to tens to hundreds of millions of dollars via payment for order flow. It's a very, very profitable business. Not for the individual person, but for all of the individuals at play, like Robinhood and Citadel. Now, the individual person gets their shares executed, but the big question is, wait a minute, if Robinhood is making money by basically selling our data and we're the customer, why does Robinhood have an incentive to actually give us the best pricing? And is the best pricing actually the best pricing? See, because if you were to get worse pricing via the payment for order flow model, if they're just like, hey, let's just shave a couple extra pennies off this guy and just give him a little worse pricing. In theory, that means Citadel can make more money, which means Citadel can kick back more money to Robinhood. And so this is where, when you talk to Vlad and Robinhood, you hear that, well, Robinhood's going to give you the best pricing, and that Robinhood prides themselves on giving their customers the best pricing. But wait a minute. Best pricing in the world of payment for order flow is not actually the best pricing. See, in a congressional hearing in February of 2021 that I watched completely and we even live streamed, we discovered that best pricing is actually the normal form of execution for trades. So this actually means there is a better version of executing trades, and that is called the premium or preferred execution model. So in other words, let's say you have a range here, a bid ask of, $10.05 to a range of $10.10. This might be the best execution pricing for a buy on this stock. But what if there was another level and it was called the preferred level, and you wanted to place an order on that stock and the range was actually 10.03 to 10.06, let's say. Or to make it simple, let's just go 5. Now, the high-frequency traders can still make money within this range. They're interested in this range. They can make money over here too. But where can they make more money? And the crazy thing that's a little crooked about the industry is, why is the preferred not called best? Why is best actually potentially the worst? And that's when you actually peel back the layer of the industry, even just a little bit, because don't get me wrong, I don't know anything. I'm just the dude on YouTube. I don't know that much about this, but I know there is a better execution model than best. And to me, that just seems a little shady. Now, I'm not saying that Robinhood's shady because of that. I'm saying the whole payment for order flow system is a little shady for that. And so this kind of brings up some of the madness that's going on with Robinhood. Obviously, what we saw on January 28th and a lot of debate over payment for order flow has led to an insane amount of lawsuits for Robinhood. I mean, we're talking over 20 different lawsuits. And I've read through some of these lawsuits. In one of them, Dan and Luck versus Robinhood, I'm going to read you a little excerpt here. Wall Street's apparent response to the successful GME short squeeze was not a soul-searching self-examination of bad bets and excessive risk, but rather a malicious attempt to disrupt retail investors' successful investment strategies while preventing Melvin Capital from going bankrupt. When Wall Street lost, they simply changed the rules. Whew! That is a juicy line right there. That is a good one. You look that one up. Dana Luck versus Robinhood. You might actually have to go into the courts to pull these lawsuit documents. I pulled every single lawsuit document, and together, myself and a helper, we found some of these quotes for us. Here's another one. Weig versus Robinhood, and that is pronounced, or well, it's spelled W-E-I-G versus Robinhood. Robinhood purposefully, willfully, and knowingly removed the stock GME from its trading platform in the midst of an unprecedented stock rise, thereby depriving retail investors of the ability to invest in the open market and manipulating the open market. Now, it's nice for lawsuits to throw in the word market manipulation, but we've covered market manipulation on this channel before. Needless to say, it's very, very difficult to argue market manipulation in the eyes of the SEC. But in the eyes of a court, the eyes of a court could totally slam Robinhood for market manipulation here. And so these lawsuits will remain a risk for Robinhood. Now, what's interesting is the SEC's definition of market manipulation requires documentation and evidence of really colluding with a group of people, like almost like a cartel, colluding with folks to purposefully manipulate a market. And in a convenient example, we could look at a pump and dump. You get, let's say, 10 YouTube influencers, all really excited about this new penny stock, and you get them to say they bought in, and you pay them for that, which I'm going to make a clear note here. Yeah, I got those courses linked down below and that expiring coupon code, which I've briefly extended because the market's poopy doopy and I got a new marketing dude. So check those out. If you still want to get use that coupon code to the moon, check out that link down below and join me in those amazing courses on building your wealth with real estate, stocks, investing, YouTube, you name it. Check it out. Get private live streams as well. But beyond that, I want you to know I've never accepted a dime for an interview or a stock to say a word about a stock. Never coordinated with a company on what to say on a stock. And so in my opinion, that's really, 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 really important. Never gotten paid. So anyway, I want to get that out of the way, okay? But this does happen. So as an example of market manipulation, imagine you do have a group of YouTubers who accept payment. And then all of a sudden on a particular day, the company announces something and all the YouTubers talk about how they bought into this company. In theory, you could pump a penny stock from, I don't know, 60 cents to $1 like that. Or $1 to $6, like that. Could happen very, very, very quickly. That would probably be deemed market manipulation by the SEC because you've got a group of individuals colluding to pump a stock at a particular point in time. It's a little bit less clear for Robinhood because Robinhood didn't invent the payment for order flow system. They just responded to it. And they responded to the disaster, allegedly, responded to the disaster of these new reserve requirements that Robinhood needed. So proving market manipulation might be a little bit tougher for Robinhood, but it's going to be fascinating to see what happens about all the other players who potentially forced Robinhood's hand. And this is not me trying to defend Robinhood, because look, we got some other big problems with Robinhoods. Oh. Robinhood, not Robinhoods. There's only one. 2 weekends ago, Warren Buffett slammed Robinhood for encouraging trader-like behavior and short-term thinking, along with getting folks exposed to risky bets like weekly call options, basically encouraging gambling. We've also got Massachusetts, the state of Massachusetts, saying that Robinhood, quote, has continued a pattern of aggressively inducing and enticing trading among customers. Obviously something that would increase Robinhood's payment for order flow and therefore profit. And is threatening, Massachusetts, is threatening to kick Robinhood out of Massachusetts entirely, basically removing Robinhood's license to operate as a possibility. Elizabeth Warren just yesterday suggested the SEC take a close look at Robinhood, and the SEC is doing just that. The SEC is evaluating whether there should be a more competitive model in the payment for order flow space. Maybe they'll write a rule that says, look, one market maker like Citadel can only make up 10% of your payment for order flow, or some sort of limitation so that there's more market maker competition. The new SEC chair echoed his concerns. He said, quote, many of these features at Robinhood encourage investors to trade more, which trading more leads to more payment for order flow revenue, and we need more competition in that space, or at the very least more disclosure. He goes on to say some academic studies suggest more active trading or even day trading results in lower long-term results for the average trader. The SEC is now investigating payment for order flow and the features of Robinhood, and at this point, I think it's worth coming up with some potential conclusions. Obviously, time will tell. Lawsuits that were filed in January from the Gamestop crisis probably won't actually wrap up when they all bundle together in a class action lawsuit, probably won't bundle up and be done until 2023. By that point, these lawsuits will simply become a little footnote disclosure on Robinhood's public filings after Robinhood ends up going public and IPOing, which they've already confidentially filed to go public. If Robinhood ends up going public in the market rebound that I hope we will have in September, October, and when the market's really nice and green again, which would be a smart time to do it, then Robinhood also, well, hopefully Robinhood also comes out and proves insane profitability, and they look back and go, hey, look, we've been top 10 in the App Store for X many weeks on the iPhone App Store. We're growing like crazy. Yeah, we had a bump there in Q1 2020, but we've gotten through it. We've improved things. We've made things better. Robinhood could actually do very well long term. And I don't actually think that these lawsuits are going to do anything other than reward maybe some monetary damage, maybe, to folks in a class action lawsuit. It's kind of like, hey, here's your postcard. You got $2 from a class action lawsuit because the attorneys got rich instead. It's entirely possible that ends up happening. Robinhood might get slapped with a fine from the SEC, but looking at the game itself, it'd probably end up being some people like Citadel and Melvin, or maybe even the DTCC that ends up getting slapped with some of the manipulation that may have happened there. Who knows if it ends up being Robinhood, but even if it is, probably just end up being a slap of a fine. Very unlikely to be a banning of Robinhood. However, you do have Massachusetts that is actively trying to kick out Robinhood and ban them. However, that's also a lawsuit, and that's going to be another couple years as well. Quite frankly, by then, if Robinhood goes public, the market recovers, people's memories are short, I don't know, Robinhood could be around to stick around. Now, that does depend, though, because I have to say, I get really peeved when I'm on Robinhood and I get stuff like this. I have to say, it's really annoying, because when you're getting red candlesticks like this and you're trying to sell, and Robinhood's telling you can't sell because you're getting error messages like this, something went wrong, kind of start freaking out a little bit. Anyway, folks, thank you so very much for watching my thoughts on Robinhood and the future of Robinhood. Appreciate y'all. Consider checking out those programs linked down below. If you want to sign up for Webull, make sure to go to metkevin.com/Webull, deposit $100, and get up to $1,850 with the trading platform Webull.